There are two main policies in macroeconomics. You already learned about fiscal, so now let's look at the other one, which is monetary policy. Monetary policy is the central bank's manipulation of the money supply and the interest rate in order to achieve economic objectives. What are economic objectives? Basically influencing price level and or real GDP. So dealing with inflation, dealing with unemployment, dealing with recessions. That's the idea here. And the way it works is through affecting aggregate demand, AD. Here's a similarity between monetary policy and fiscal policy. Both of them act through aggregate demand. Both of them are demand side policies. So we have two main tools here. One of them is the money supply, and the other one is the interest rate. Okay. The thing is, the central bank can either target MS or I, but not both. Okay, because they are interdependent. So if you remember, you had this money market, and in the money market, when money supply changed, interest rate also changed. So you cannot target them independently. Okay, you set one of them and the other one follows. So the central bank sets the interest rate directly, and money supply responds to that. And the way practically doing it is through what we call open market operations, and that's the purchase and sale of government securities by the central bank. These government securities are the same as bonds, which you've seen before. So purchasing bonds means buying government's debt. So bonds, if you remember, are IOU papers. These are what the government issues when it wants to borrow money. A bond is government's way of borrowing. If you buy a bond, you are lending to the government. All right. So when the government wants some funds, but it doesn't want to raise taxes, it can issue bonds. Pause here and take down your notes. Central to monetary policy is this overnight interest rate, and that's the interest rate that commercial banks charge one another for overnight loans. So imagine taking a loan for only one night. So that's a very short-term loan. What is the interest on that? Okay, that's called the overnight interest rate. This is only between commercial banks themselves and also between them and the central bank. The idea is that sometimes commercial banks need cash because they run out of reserves, or they have excess reserves so they can lend out. So they have these clearing transactions between each other every night. Okay, the interest rate that governs that is called overnight rate, and that's determined by the central bank. That is how the central bank conducts monetary policy. It fluctuates daily because the cash requirements of the banks change. So sometimes banks need to lend, sometimes they need to borrow. It is the most short-term interest rate. So other long-term rates would follow it. So it's kind of like the basis, it's kind of like the root, and other long-term rates. So long-term rates are like what? Like credit card rates, like mortgages. All right. So corporate loans. Those things follow the overnight rate. The central bank has a target for the overnight interest rate. Okay. Now, if the current market rate is above the central bank's target, which means if the central bank wants to lower the rate, what should they do? Imagine you're the central bank and you want to lower the interest rate. What do? Remember, you are the monetary authority, so you can print money if you want. You have a lot of reserves. So borrowers will have an incentive to borrow from the central bank. The central bank offers loans at a lower rate because it wants to lower the rate. Yeah. So any commercial bank that wants to borrow money, they're going to borrow from the central bank instead of the other commercial banks. If the current market rate is below the central bank's target, so if the central bank wants to raise the interest rate, if they want to raise the interest rate, they're going to raise their target, and the lenders will have an incentive to lend to the central bank. So in the first case, the central bank operates as a lender. In the second case, the central bank operates as a borrower. Either way, the central bank is going to win because of competition, basically, because it's offering a better rate compared to the other borrowers or the other lenders. All right. So the commercial banks will have to follow suit. Whatever is the target of the central bank is going to be effective. As it turns out, the Bank of Canada targets neither the money supply nor the interest rate, but the inflation rate. And this has been around since 1991 when they decided to target inflation, and by 1995 they reduced the target to 2%. So the target inflation is 2% plus and minus 1. So as long as the inflation rate per year is between 1 and 3%, the central bank is happy. If it's lower or higher, then they would intervene to make it come back to that range. It's been quite successful. We have been able to control inflation. All right. Now, what is the main problem with inflation? The main problem with inflation is uncertainty. It creates instability, and we don't like that. So, in and of itself, uncertainty is undesirable. It reduces our well-being. And high inflation tends to be very volatile, which means unpredictable, right? So, if the inflation rate is very high, it changes also a lot, and people cannot make decisions about future. Firms and households can make long-term decisions because of inflation. So we really want to get rid of inflation. And the most effective way of combating inflation is through monetary policy. Why? Because sustained inflation is always and everywhere a monetary phenomenon. That's the discovery of the great economist of the last century, Milton Friedman. So because monetary policy is so effective in controlling inflation, and because it is not effective in doing anything else, well, we use it to combat inflation. Monetary policy can have real effects only in the short run, but in the long run, it has only nominal effects, right? So real effects mean affecting real GDP or unemployment or investment. And when it says investment, what it means is real investment, not just the dollar value. Nominal effects mean the price level, like the inflation. All right. So monetary policy in the long run only affects the price level. That was the idea of the long run neutrality of money. If you don't remember, the long run neutrality of money, refer to your notes from last week. That's quite important. That's the idea here. In the short run, it could have some real effect, but it's going to be offset in the long run. So pause here and write down. When it comes to inflation targeting, the central bank focuses on this thing called core inflation, and that is based on the CPI, but it excludes food and energy prices. So if you remember, CPI is the consumer price index, which is an average price of all goods and services bought by the households, right? Or a basket of 600 goods and services that the households primarily buy. And the main part of that are food items and energy items, right? So energy, you can think of it as oil and gas. The thing is that these things are volatile imported commodities. So most of our food items have an important element of imports. Most of our energy also is imported. So if the price of food and energy changes, it's primarily because of external international events, right? So we want to focus on our own situation domestically. We don't want our government or the central bank to interfere domestically because of some price change elsewhere. Okay, if there is an event in some other part of the world which is driving the food and energy prices up and down, why should we change our own policy? So the change in their prices are unrelated to Canada's output gap. All right. For this reason, we kind of exclude them from our inflation calculations so that we can focus on things that actually matter to us. We have two types of monetary policy. One of them is contractionary, kind of like fiscal policy, which also had two types. So that's intended to contract the GDP and primarily to combat inflation, right? So the way it works is through raising the interest rate. And if you remember your money market, the interest rate would go up whenever the money supply goes down. So the central bank contracts the money supply. If you have a graph, you would shift the money supply to the left, and you're going to see that the equilibrium interest rate goes up. What is the interest rate? Interest rate is the cost of borrowing. If it costs more to borrow, then the level of borrowing is going to drop. And who are the borrowers? Well, households borrow money primarily for major durable goods, right? Like cars, non-American cars, right? And firms also borrow to invest in their business. So consumption goes down, investment goes down. Also, net exports will go down. So you'll have to remember the idea of inflows and outflows. If the interest rate is higher in Canada, what would the investors elsewhere do? They're going to be attracted to invest in our assets. So they would want to buy our stocks and bonds because they pay higher interest. And for that, they will need Canadian dollars. So the demand for Canadian dollars is going to go up. Our currency is going to appreciate. If our currency appreciates, our exports are going to drop. Our imports are going to rise because it's easier for us to buy from them. It's harder for them to buy from us. Anyway, the net effect of all that is that net exports will drop. And all of these together will result in less aggregate expenditure. All right, so remember your formula. And if aggregate expenditure is lower, the AD is going to be lower, and in the graph, you're going to shift it to the left. So do a little sketch for yourself. Draw the AD/AS. What happens if the AD shifts to the left? What happens to the GDP? What happens to the price? You're going to see the GDP is going to drop. The price level also is going to drop. And that is the same as lower inflation, right? So contractionary monetary policy results in lower inflation. By the way, if you get questions like this, which you will, you'll have to be able to explain all of the steps. So you should be able to break it down, kind of like you have on the screen. You don't have to use arrows if you don't like them. You can write a sentence, but arrows are also fine. And whenever you use this AE formula, you must write it down. So write out the whole formula whenever you use it. So in this case, you have C, I, and NX. Well, you'll have to write out the formula. All right, so there are partial marks for these things. The other policy type is expansionary monetary policy, and that's intended to expand the GDP to combat unemployment. So we had two evils in economics. One of them is inflation, the other one is unemployment. So we can use monetary policy in two different ways to combat them. And you should be able to figure these out. So you take a few minutes to write how it works, what should the central bank do to the interest rate, and what happens to the borrowing, and write out all of the steps. This is an extremely useful practice for yourselves. Wow, that's kind of cool. So the idea with the expansionary monetary policy is to combat unemployment. Pause here and write down your notes and complete the last part. So you have seen the idea of wages before. Wage is the price of labor. It's an input cost. So if you remember the bakery example, we have a bakery which produces bread and it uses flour as an input. So labor is an input and wage would be the price of flour, basically. Now, if the wages go up, which means if flour becomes more expensive, our bread production goes down. So our aggregate supply, our total production of goods and services is going to drop. If flour is cheaper, well, the companies can buy more and they can produce more bread. So that's old stuff. That's really just the bakery example. Now, why would the wages change? So one reason is output gaps. This is really the long-run adjustment process that we've seen before. If there is excess demand for labor, what's going to happen? If there's too much demand for anything, its price is going to go up, right? So in this case, the wages are going to go up. If there is excess supply of labor, if there is too much supply of anything, if there's a surplus, its price is going to go down. So this is basic shortage and surplus. Another cause for the change in wages is expectation of future inflation. If people expect the prices to rise in the future, what are they going to do now? The workers and the unions will start negotiating a raise. And when they start negotiating a raise, it's likely that the wages will go up. Remember, unions have a lot of power, and if the expectations are common, if they're widespread across the country, it's very likely that the firms will accept because they have the same expectations. So write down.
Ah, MacBain. So glad you could make it. Have a salmon puff.
All right.
That is one evil dude.
It's just a movie, son. There's nobody that evil in real life.
Smithers, where's that union representative? He's 20 minutes late.
I don't know, sir. He hasn't been seen since he promised to clean up the union.
Whoa! What the hell? Well, let's look at the contract ourselves, eh? Benefits, perks, a green cookie on St. Patrick's Day. Oh, it didn't used to be this way, Smithers. No, it didn't used to be this way at all. Come on, crack those atoms. You, turn out those pockets. Atoms. 1, 2, 3, 4, 6 of them. Take him away.
You can't treat the working man this way. One day we'll form a union and get the fair and equitable treatment we deserve. Then we'll go too far and get corrupt and shiftless. And the Japanese will eat us alive.
The Japanese? Those sandal-wearing goldfish tenders? Bosh, flimshaw. If only we had listened to that boy instead of walling him up in the abandoned coke oven. Well, I am going to avenge my grandfather. We'll take on that greedy union, and we'll get back our dental plan.
Can you guess what is stagflation? It's really a mix of two words, right? So the second part is inflation and the first part is stagnation. Basically, it means when prices go up and GDP goes down simultaneously. And if you remember your ADAS diagram, that would happen when the aggregate supply curve shifts to the left. The result is inflation and unemployment at once. So you get both evils of macroeconomics at the same time, and that's a horrible condition. Okay, so yeah, you have kind of like a monster that you've never seen, and that's primarily because of inflationary expectations remaining after the output gaps are closed. So if you have these expectations are horrible. So expectations are quite important in macroeconomics. They're kind of like a self-fulfilling prophecy, and it continues until people's expectations are revised, and unless the inflationary expectations are validated by fiscal or monetary policy. So usually people's expectations adjust quickly. The problem is when there is a policy interference that could influence the expectations of the people. We have something called deflation, which is a negative rate of inflation when the prices fall. Now, if you think of it, is it common for the prices to fall? It's not very common. Actually, it almost never happens because of expectations of people. People already expect prices to rise, and because there is always some monetary expansion. It happened during the Great Depression and also in Japan in the 2000s, but those are two very rare examples of deflation. I love this picture, by the way. Like when the roller coaster is going up, that's kind of like inflation. And then it goes down, it's kind of like a recession. And then stagflation is kind of like things are stagnant and the prices are high, and deflation would be when things really go down. There is something that's more common, and that's disinflation, and that's a reduction in the rate of inflation when the prices rise but at a slower pace, and that's due to a monetary contraction. All right, so that's common. So if the inflation rate drops from 3% to 2%, that's called a disinflation. Write down. Just to recap, that expectations are quite important in macroeconomics. They are self-fulfilling. If people expect something to happen, they act in a way that it actually happens. And there are a couple of important theories for expectations. One of them is called the backward-looking expectations, which is predicting the future based on what happened in the past, right? So what it means is if you're walking forward, you're looking backwards, which is really stupid, right? If you think of it, I mean, it's very naive to expect the future to be exactly as the past. If last year's inflation was 5%, just based on that piece of information, you would predict that this year is also going to be 5%. That's naive because everybody knows that everything is always changing. So these are also slow to change because you're always looking at the past and it takes time for you to update your information. The other theory, which is more logical, is forward-looking expectations, which is forecasting future not only based on past data, but also by looking at the current conditions and announcements. And these are quicker to adjust. So yeah, maybe last year's inflation was 5%. If this year the central bank announced that it's going to be 5%, then you take that. If they announce that it's going to be less, then you take that. So you always take new information into consideration. So that's kind of like if you're walking forward, if you're walking to the left, then you're also looking forward. Oh no, that looks like Pinocchio. But anyways, that's it. It's kind of like a logical thing to do. When you're looking forward, you look forward. Okay. Most governments are actually backward looking in practice. They claim to be forward looking, but in practice they are backward looking because there's a lot of rigidity and status quo involved in policy. There are a lot of administrative complications and a lot of lobbyist obstacles, which make the governments to be slow to adjust. There is another version of the forward-looking, so rational expectations are really another version, another expression of the same forward-looking, and that's the idea that people make the best use of the information at their disposal to form their expectations. So whatever relevant information there is around them, they make use of that. They don't make persistent errors, but learn quickly from their mistakes. So it's possible that people make mistakes once in a while, but they quickly learn from their mistakes. If somebody repeats the same mistake over and over again, then there is something wrong. I mean, that's irrational. It is possible to predict people's behavior, all right? And this is quite important, predict. Rationality, the rational expectations theory, it doesn't say that people are geniuses. It doesn't say that people are Einsteins. It's none of that. It's very simple. All it's saying is that it's possible to predict people's behavior. There is some basis for people's behavior. It's not about right or wrong. It's not about good and bad. It's just about having some form of basis, some form of order. If you cannot predict someone's behavior, then that's irrational. People are not stupid, right? That's just putting it very simply. And this is not a joke. This is really an important point. Sometimes when you read the news or you hear to some speakers, it sounds as if people are a bunch of mindless fools who don't know what they're doing. With that kind of assumption, you cannot have any kind of social science. You cannot predict people's behavior. You need to assume that there is some basis to what they do. All right? So that's somewhat important. And pause here and take your notes. Next, we're going to watch a funny video. You don't have to take notes on it. It shows what it means to be stupid, basically. It means how to repeat the same mistake. Again, something that you've seen before, the natural rate of unemployment, U star, that is the unemployment rate when actual GDP equals potential GDP. Okay, so Y equals Y star. That is called the full employment, all right? Now, full employment doesn't mean it's zero employment, but it's more practical than that. It is also called NAIRU, non-accelerating inflation rate of unemployment. If you see that word NAIRU, the book uses it. It simply means natural rate of unemployment. Okay, that is when there is only frictional and structural unemployment, but not cyclical unemployment. So this is where you might need to refer back to your notes from intro about the different types of unemployment. Basically, we had this thing called structural unemployment, which is when there is a mismatch in skills because of new technology. So you can think of the self-checkouts. The self-checkouts are a good example of it because they replace the cashiers, right? So whenever there is new technology or whenever there is no need for some skills of people, maybe because of international trade, some jobs are relocated and outsourced, that's structural. Frictional is when people move between jobs, all right? I love that picture when you have, you're in some small bowl and then you want to move to somewhere bigger. This could be physical moving from one city to another, or it could be just moving between jobs. Between those two jobs in the interim period, you're unemployed, or because of graduating from school and until you find a job. So you're always between two stages of life. And there is cyclical, which is because of recession, okay, because of lower production by firms, right? There is also seasonal unemployment because it's off season, right? So some people don't have a job during winter, some people don't have a job during summer, but that's already accounted for in the unemployment calculations. The data are recorded quarterly, so it does adjust for seasonal variation. So you're not really concerned with that. Now think of structural and frictional. Is it natural for people to move between jobs? Is it natural for people to move between cities? Is it natural for people to grow up and graduate from school? Yeah, so frictional unemployment is quite a natural part of life. It's unavoidable. Structural also, there is always new technology coming in. There is also new ways of doing things. And we don't want to avoid that either. That's not really a problem. So frictional and structural unemployment are a natural part of life, and we cannot avoid them. They're not a big issue. The real problem, though, is cyclical. So cyclical is when the whole economy is doing bad, right? And that creates unemployment. That's a concern, right? So we would like to get rid of cyclical unemployment, but as long as there is only structural and frictional, that's natural. All right, so you can say that structural unemployment affects one industry and region. Frictional affects one individual or one family, so it's even a smaller scale. And cyclical affects the whole nation. All right, and structural is really a long-term frictional unemployment. Okay, they're really the same in nature, but one of them is more systematic. So structural is more systematic and it takes longer to adjust. Okay, in the case of structural unemployment, people have to be retrained and reskilled for a new position. During a recessionary gap, our unemployment rate is greater than the natural rate. During an inflationary gap, our unemployment is less than the natural rate, and that was the idea of the Phillips curve. Again, if anything here is ambiguous, you may need to refer to your notes from intro and possibly your notes on the Phillips curve. But pause here and write down the notes. Imagine some demographic change where there is higher labor force participation by youths. So for instance, there is a greater youth population in a society. What happens is that with the youth, they usually tend to have a higher rate of frictional unemployment. Remember, the youth that's the age when people get to the working age, and also the age where they graduate from high school or from college. So they are looking for jobs, and that is frictional unemployment. So if you have a greater ratio of youths, then there's going to be greater frictional unemployment, and that's going to raise the natural rate of unemployment. So the natural rate of unemployment could be affected by demographic changes. Another possible reason is generous welfare programs. If the government provides very generous welfare programs to people who are unemployed, what's going to happen to them? The unemployed will have less incentive to accept a new job. Because if they don't accept a new job, they're receiving welfares, and that's not such a bad idea, right? So again, the frictional unemployment is going to go up because people are going to be between jobs for a longer period of time, and that's going to raise the natural rate of unemployment. What is key here, what is central to all this discussion is this idea of incentives. Whenever there is a policy, you have to think about how it's going to affect the incentives of each side. A similar concept is mandated job security. And that's the idea that when firms can't lay off workers without demonstrating a cause, giving advance notice, or paying severance payments. And this is there in a lot of countries where firms cannot simply lay off workers. By law, they cannot. They should give them advance notice, or they should pay them severance payments. So this is an additional cost to the firms. And because of that, they are going to pass it on to the workers. So they'll be hesitant to hire the workers in the first place, which is again going to raise the natural rate of unemployment. Again, it's very important to pause here and think about the incentives involved. Sometimes it may seem like a smart idea to impose a law, but keep in mind that if you impose some cost on someone, they're going to avoid it as much as they can. They're going to pass it on to the workers, and maybe it ends up defeating the purpose. Any policy that makes the labor market less flexible, that reduces the freedom of employers and employees to give jobs and accept jobs, any policy that reduces freedom is going to raise the natural rate of unemployment. Write down. A relevant concept here is labor mobility, and that is basically when workers are able and willing to move between regions and industries. That is going to result in lower unemployment rate because they're going to be absorbed in other places sooner. So a good example of that would be the European Union, which removed a lot of barriers from traveling and working in other countries. And a lot of people in, let's say, Eastern European countries to travel to other countries for a job, right? Now, one relevant issue here would be language laws, which could create rigidities. The overall idea is that if people are more able to travel and relocate and get a job elsewhere, it is going to help unemployment go down. If it is costly for firms to hire workers, they will try to switch to more capital-based methods of production. So remember, we have resources. We have labor and we also have capital. If labor is more costly, firms are going to opt for something less costly, let's say capital. So they're going to try to replace the workers with machines, right? Again, the whole theme here is incentives. Firms and workers respond to incentives. If you want to reduce unemployment, you should really think about how each side is going to respond to the incentives and to the laws that are put in effect.